Hello, everyone. I hope you're doing well. Today, we're going to be talking about borrowing to invest, leverage investing, that whole shebang, I guess. Now, a lot of people understand that traditionally, the way that you would invest is you would determine, okay, I can afford $500 per month, and I am going to go ahead and invest this $500 per month. And over time, this is going to grow, accumulate, and the interest, of course, will allow this to compound. Thus, you're going to be getting exponential growth over time, compounding growth and returns. Now, the not necessarily the challenge with this, but a lot of people go, okay, well, what happens if I want to try and speed this up a little bit? Because you can imagine, even if you're earning, say, a 10% interest rate, a return of investment of 10%, well, 10% on $500 isn't so much when you compare 10% on, say, $50,000, of course, right? I know I'm not uh, giving anything crazy or huge here, but it's just true. So essentially, there's this concept whereby you can go to and let's just scroll down here, where you can go to a bank, and the bank will lend you via a loan some capital, which you then go and invest that capital. And the goal is that you are going to now be profiting more because of the amount of the loan. Now, most people are very familiar with this topic, right? So let's go for example, and I've got a calculator, and I'll copy and paste stuff. I'm going to be doing this live. Let's say you wanted to get a loan that has I don't know. Let's get as close to a monthly payment as to $500 as possible. Okay, so let's say $75,000 loan. Let's say the interest rate, today's marketplace is going to be, say, I don't know, 5%. We're just going to pretend, okay? Okay, so we can go a little bit higher than that. So an $85,000 loan. Alrighty, okay. So an $85,000 loan would have a payment of $496 per month and 90 cents, assuming it's a 25-year loan. Now, you can get interest only loans. You can do all kinds of stuff. I'm using 25 years. Honestly, if I was to cover every single little eventuality of this process working, like, we would be here for a very long time. So let's just go with this, okay? And now let's assume that over an extended period of time, you're now going to be making, say, 6%, right? So you expect your ROI to equal 6% in the long run. So now, clearly, the math already supports an increase. So this loan over here, the interest rate was 5%. We're earning 6%, and thus on $85,000, our actual interest cost, not including principal, because remember, you can't include principal because that's what you would have invested otherwise, um, ultimately ends up being, give me a second here. $4,200. So cost on this side is $4,250, and your ROI on this, $8,500 multiplied by 6% now, whoops, is 51. So return is $5,100. Now you can already see that there is a difference here of about $850. Now, how much did this $850 actually cost you at the end of the day? Um, Ultimately, you most likely would not have been able to make $850 in return over this course, this time. And I say most likely not because, of course, we can't control all the ROI and all this type of stuff. The known variable that we have right now is the interest cost. So obviously, not everything is certain, but let's pretend that you take in this $496.90 and you've invested for the entire year. Well, you would have had $6,000 invested, and $6,000, and it's actually $5,960.80. You would have only got a return of 375. So there's essentially three options here that you would have had. You could have, well, two. You could have taken the loan, invested it, made $850 positive cash flow. return. Or you could have taken your $496.90, multiplied it over 12 months is now equal to $5,962.80. Multiply that by 6% now is equal to a return of $357.76. So for the exact same cash flow, the same outlay, your $496.90, you have more than 100%ed your return on your investment. Now, you have to realize this can go both ways, right? Of course, if the return was a negative return and your $85,000 account went down to 80,000, well, that yields a problem. If you can't make this payment, well, now you have a credit issue that's going on. You may not get 6% return. There's a whole host of risks that are associated with this, okay? And you just have to be aware of that. But what you can do is multiply returns. So, what I see a lot of people doing, and kind of where I would recommend people stay away from here, let's clear the board, okay, is leveraging too much. All right, leveraging too much. Now, what happens? And if you've ever heard of anyone leveraging, it's a less popular strategy now because kind of in the 06, 07, 08 kind of pre-market, I guess, it was very, very popular strategy. People were getting all kinds of investment loans out there, is that they just couldn't handle the big dip, right? So this may sound strange and it will reduce your returns, but if you are considering this strategy, whatever your budget is, okay, I would consider only leveraging a percentage of that budget, right? And so, for example, if we continue with our trend of having roughly $500 per month, okay, maybe go get an investment loan of $250 per month. Now, again, using a 25-year mortgage at a 5% rate, you're roughly going to be speaking, again, you just cut the numbers in half, roughly speaking, $42,500. And so you'll get a loan with a payment of this. So $42,500 loan, and then take your other $250 per month and just invest it as you normally would. And this will allow you to kind of I guess, hedge yourself, right? Because this money that you have here isn't tied to any market in any way, shape, or form. Another strategy you could do to help reduce the drawdown, essentially, basically your balance and how far below your balance goes, is maybe you say, okay, I'm going to do $400 per month. That's going to go into this investment account, this loan, right? And then I'm going to just simply put $100 per month into a savings account. Now, the savings account doesn't need to yield much interest, if any at all. But the reality is you'd be saving $1,200 per year. That now, if your loan and your investment account decreases in value, well, ultimately you would have this hedge in order to make the payments on the loan or bring the account balance up to account for the dip in the share prices, et cetera, so you can kind of maximize the profits, right? And then thirdly to that, and I'm not going to talk about IBC in here too greatly, but perhaps it is looking at an investment loan and then investing this other component into the whole life, or perhaps it's taking this entire amount, investing in the whole life, and then using that to invest because of the continued compound growth and the infinite banking policy. But anyway, I just wanted to have this really quick discussion on leveraging and borrowing to invest. Is it a good strategy? Absolutely. Where I think it gets this bad name from is that people try to leverage way too much. Don't do that. Slow and steady will win the race in the long run. There's nothing wrong with investing via leverage products. You just have to understand the risks, and you have to make sure that the asset you're leveraging into, you understand it, or at least understand the risks associated with it. So I hope that makes sense. Thanks you very much for checking out the channel. If you like the video, subscribe to the channel if you want to see more. This channel really is a discussion piece about a whole bunch of various financial topics. I don't really prepare all that much for these conversations. We just go at it and we have a lot of fun. So cheers.